Oil prices are down sharply after China placed the financial hub Shanghai under lockdown due to rising coronavirus infections. The international benchmark Brent fell more than 5% and is now trading at around $115 a barrel. Fresh COVID-19 restrictions in the city of 26 million people are exacerbating concerns over a possible dip in demand for fuel from the world's biggest crude importer. At least for today, that's overshadowed fears linked to the Ukraine crisis and sanctions on Russia, a major exporter of oil. Shanghai is a major trade and banking center and China's second largest city. Beijing is sticking to its mass testing and citywide lockdown approach to curb outbreaks, even as other major economies open back up.
We've detected many infections after several rounds of screening, so the situation we're facing is still severe and complicated. Our next step is to continue screening work. We'll combine two different screening methods of nucleic acid testing and antigen testing. Starting today, we'll conduct nucleic acid tests for the key areas in the outbreak and carry out antigen testing for non-key areas.
All right, for more, let's go to Naeem Aslam. He's the chief market analyst at AvaTrade and joins us from Bodrum in Türkiye. Welcome back to the program, Naeem. Now, this lockdown obviously is the most immediate concern for China, but can you tell us about the Chinese economy at large and the concerns there? What are the prospects for the world's second largest economy, and what does that mean for oil demand this year?
Sure, thanks for having me. Look, as you have correctly mentioned earlier in the show, China is not a small player. And then these cities and provinces which are going under lockdown because of that strict and rigid policies imposed by the Chinese government represents a risk for oil demand. By the way, yes, these major cities are in a major lockdown, but Brent oil prices, as you mentioned correctly, is still trading above that $100 price level. So as long as the price is holding those particular levels of that $100 price level, the path of least resistance is skewed to the upside for two major reasons. Because demand on a global basis is still increasing. Number two, that particular move where everyone was talking about, let's move away from fossil fuel and then now let's go towards a renewable energy. That stance has been massively impacted by having sanctions from the US and its allies on Russia. Now, in the short to medium term, the vacuum which is created because of the short of finance lines are really likely to keep the prices anchored in place for from the short term to medium term perspective.
Now, speaking of that vacuum in supply, we have this OPEC Plus meeting. Those are the world's oil exporters happening later this week. What do you expect from this group?
So traders are expecting that gradual increase from these ones. They wanted to see if they are really going to dig deep into their the spare capacity that these countries or the cartel has, and if they're really going to do anything about that. But more importantly, the conversations are going to be focused on two things from traders' perspective. Number one, that Iran deal. If that comes back in, how much more oil can we see on the market? Number two, if we are going to see sanctions on Russia, will we see the consumption of oil from Russia's perspective? Basically, will that oil be taken up from India and, of course, China? Because right now, we're seeing that India is really taking advantage of cheaper oil prices from Russia and taking that oil off the market.
All right. Naeem Aslam from AvaTrade, thank you for joining us and making the time.
Thank you for having me.